Hey, good morning. I'm Dan Moorhead. Thanks for joining this call on the case for blockchain investing. I have all of my investment partners with me, Paul Radhataka and Joey Krug, and then the entire investment team. We try and host these once a month to share information we think would be generally interesting to the community. Sometimes they have a very specific topic where we do a deep dive with CEOs in the space, and sometimes they're more general. Today is one of those general ones. We're really here to spread information and knowledge about the space. So if you have questions, please use the Q&A box. Our investment team will answer them real time as we go. If there's anything generally interesting that's worth us wrapping up at the end with, we'll answer it for everyone. But for those that do have questions, even on specific deals or specific questions on projects we're invested in, we're happy to answer those. First, I want to give a little background on the firm. Pantera's been around for 17 years. I founded it after leaving Tiger Management, and we launched the first cryptocurrency fund in the US, and then the first blockchain venture fund. And since then, we've tried to push out ways for investors to get exposure to each of the categories in the space. And later on today, I'll talk about the fact we are offering a wrapper to allow investors to get exposure to the entire spectrum. I want to give a little introduction to my two partners. Joey Krug is the co-CIO. He joined Pantera 4 years ago. Prior to that, he founded Augur, which is the first platform built on top of Ethereum. And then Paul Radhataka and I have been partnered for over 7 years. The rest of the firm we have about 40 people in total. About 12 or 13 on the investment side, and the rest supporting the business. And with that, I wanted to hand it over to Joey to talk about our thesis.
Awesome. Thanks, Dan. So if you look at the thesis of the firm, the idea really at its core is that this technology is kind of the beginnings of a new financial infrastructure and a new parallel financial system, very similar to how the internet itself was the beginnings of this new kind of information infrastructure, and you had new forms of creating and consuming content. The same thing is happening here, but this time it's happening within finance. We'll go into a bit more detail on that. So if you look at the different protocols in the space, way back in 2009, Bitcoin came out, sort of a child of the financial crisis. And the idea behind it is you have global transactions, relatively low fees. You can send any amount that you want globally for the same fee, and it's this digital store of value. People call Bitcoin digital gold. And the breakthrough with Bitcoin that other digital currencies in the past were not able to solve was, how do you make sure that you can't spend the same money twice? So basically, the idea that I might send both Dan and Paul $100 and try to say that I both gave it to them, even though I originally only had $100. Turns out that's a pretty tough problem in computer science, and Satoshi Nakamoto was able to solve that problem. Not a lot changed though for 4 or 5 years until Ethereum came out in 2015. And with Ethereum, the idea was, what if you took the technology behind Bitcoin and added the ability to do smart contracts, or basically, what if you added the ability to write code on top of the money, or the ability to basically program the money is another way to say it. And what Ethereum has enabled is this huge, wide array of different financial protocols. Basically lets you re-implement any sort of component you could think of from the legacy financial system, but completely digital. And we'll talk about some of those use cases in a moment. The next wave of things that are coming out are improvements to things like Ethereum, whether that's Ethereum 2.0 itself, side chains, or what are called layer 2s to Ethereum, or things like Polkadot, which are basically new blockchains that are much more scalable than ETH itself. That's kind of the next direction that things are going. Bitcoin and Ethereum, they do anywhere from 10 to 20 transactions a second. Newer protocols are enabling hundreds or thousands of transactions a second, which is really what you need for this to scale. And so if you look at the areas that we're focused on and investing in, for the most part, they're financial use cases. A lot of these, wealth storage, finance exchanges, custody, payments, All those use cases are inherently, financial use cases that are either, supporting, underlying DeFi, decentralized finance protocols, or they're bridges between the existing financial system and, what we call the new one. There's a few other categories though, things like developer tools and infrastructure that make it easier for developers to build using this technology. And then also kind of some more one-off, use cases, things like social media networks, digital collectibles, non-fungible tokens. There's a few consumer applications in the space. I think consumer in the space is going to grow over the next 5 to 10 years. In the beginning, it was mostly all infrastructure, but now that it's getting much easier to build in this space, I do think we will see more consumer apps going forward. And so if we look at, decentralized finance, there's really 5 components of any financial system. You have the unit of account, what are trades denominated in? Globally today, that's for the most part is the US dollar. And then, you have an exchange. These allow you to trade assets. You have lending and issuance of debt. You have margin, and then you have leverage. And with those 5 components, you basically can construct a financial system. And the punchline is people are making, digitally native, smart contract-based versions of all of these things on top of Ethereum today. And the interesting thing about it is it's growing really rapidly. If we go to the next slide, you can see the growth in crypto lending protocols. So these are people who are basically borrowing against their cryptocurrencies, similar to how you would, maybe give your Apple stock to international brokers and borrow against it. That's the use case today. Eventually, there'll be other types of lending on these systems too. But with Compound, Aave, and Maker, you can basically do that. You could either borrow and then go buy something else. You could go borrow and buy more cryptocurrency, or you could deposit, Ether and borrow some other altcoin, effectively just short it. Those are the use cases today. And from a growth standpoint, at the beginning of last year, there was really very little value locked up in these protocols, anywhere from tens to hundreds of millions of dollars. Today, it's in the high 30s of billions of dollars. So it's a massive growth in just 1 year. The other main use case in the decentralized finance space that's gotten traction is exchanges. So these are exchanges that you don't need to go there and create an account. It's non-custodial. So you just show up with your funds, you do what trade you want to do, and then you get the assets back in like 30 seconds. And that's the end of it. There's no deposit or withdrawal wait. There's no delays. There's no transaction limit. All that kind of stuff doesn't exist. And also usually the fees are much cheaper than centralized exchanges. And often now you're actually starting to see there be more liquidity, at kind of the market price indexes than centralized exchanges for really popular trading pairs. That's not always true, but it's becoming more and more true. 3 years ago, it was never true. These days, it's quite often the case that the decentralized exchange actually offers you a better rate depending on what you're trading. And from a traction standpoint, the amount of value locked up in decentralized exchanges was effectively rounded down to 0 beginning of last year. This year it's about 20 billion. Trading volumes, Uniswap does anywhere from 30 to 40% of Coinbase's daily volume on average at this point, versus 2 years ago, it's effectively sub 1%. So there's been a massive growth in DEXs as well. And so if you look at the DeFi ecosystem, there's a few main components. You have the underlying blockchains that people build on, things like Ethereum, Polkadot, Near, Cosmos. Then you have, oracles, which are a way to get data about the real world into the blockchain. There's a lot of financial contracts that depend on some real world piece of data. It could be anything from, the price of Ether on Coinbase all the way to, who won the presidential election. There's kind of a wide range of pieces of information about the real world that you might want the blockchain to know, and oracles enable you to get that data. One layer up, you have kind of the core DeFi protocols, lending protocols, exchanges. You have some that are focused more on payments. One layer up from that, you have synthetic assets and decentralized derivatives exchanges. These let you trade on Mir, for instance, lets you trade on, the prices of real world assets like Tesla and Apple stock, but on the blockchain. So it trades, 24/7 globally. And then you also have derivatives exchanges focused on the crypto space, people trading ETH and Bitcoin effectively on leverage or margin. The very last thing you have at the very top is the aggregator or the wallet layer. Um, these are things like 1inch, Matcha, Instadapp, that basically are the place where the end user goes to do what they want to do. So as an example, these decentralized exchange aggregators, you go there, you give them your order, and they route the order across, up to 40 or so different decentralized exchanges to give you the best price, just like you would with a traditional prime broker in traditional finance. The difference is, of course, that the settlement happens as soon as the trade happens. You get your funds and you can walk away. It doesn't matter if it's 3 a.m. on Christmas Eve or during traditional trading hours. It all happens in a matter of seconds. And so looking at another metric of growth in the space, just looking at the space kind of holistically, value locked in DeFi protocols, around $1 billion at the ending of last year, now around $60 billion. You look at trading volume in decentralized exchanges, February 2020 was about $1 billion a month. February 2021 was about 74 billion a month. And so, that's a 70x growth in the volume metric, and over 60x growth in the value locked metric. Really impressive growth that is impressive for any company, but it's really kind of crazy to see even within crypto. It's surprising to me how fast DeFi has grown. And then the last thing I'll go over before turning it back to Dan to talk about the macro view again is the stablecoin market. And so these are, one thing you hear people talk about a lot is central bank backed, digital currencies, digital versions of the dollar, all that kind of stuff. And the interesting thing is that the digital dollars are already here, and it probably actually works better than what the Fed would come up with anyways. Things like USDC, which lets you basically send dollars, outside of banking hours, 24/7. It's really interesting. I saw a blog post the other day where somebody said, cryptocurrency and decentralized finance is like, it's the people's version of the euro dollar, which is kind of an interesting statement. And it's kind of, correct, but it's even better than the euro dollar because it's 24/7, under 30 seconds, very, very low fees to transfer it globally. And stable coins have grown a lot. In 2017, Tether was the only stablecoin that really existed. Today, there's over $70 billion worth of stablecoin market cap.
Thanks, Joey. So to give some perspective, why now? Joey and I have been interested in blockchain since 2011. We've had funds for 8 years. We've been evangelizing all the benefits of blockchain. What's different right now is just so amazing. The monetary printing after the pandemic is literally off the charts. The United States printed more money in June than it did in the first 200 years of its existence. And there are so many features of this pandemic that I have no clue how to comprehend. But the one thing I do know, if you print trillions and trillions of dollars of new paper money, the value of that paper money has to go down. And so the price of everything else that's not quantitatively easable will go up. And you've seen that the price of anything whose quantity can't be eased has gone up, priced in paper money. So many of the things you're well aware of, like gold and Bitcoin, have gone up. But even the shares of the S&P 500, you can't print extra shares of the S&P 500. It's not quantitatively easable. And although we've had a global depression, which has crushed corporate earnings, and if someone would have told you a little bit over a year ago that the S&P would go up after a depression, you would have probably said there's no chance. But with so much money being printed, it did. It's also happening to corn, soybeans, basically everything that you can't make more of. The United States is printing deficits that are larger than any year during World War II. And there's only 1 year in the Great Depression that there was a single year with a larger deficit, but the US seems to be now in multi-year run of high deficits. That's brought in a bunch of legendary investors into Bitcoin. Stan Druckenmiller is obviously, one of the most successful investors. He recently bought Bitcoin and said it reminded him of gold. Paul Tudor Jones as well used the gold analog. He said it reminded him of gold in the 1970s, which I think is a really good, very simple way to describe what it is. Also, Bill Miller, legendary stock investor's been invested for 5 or 6 years in the space, and then lately, more and more very influential investors have invested. That's helping corporations and other institutional investors invest. We have very high-profile investors like Elon Musk and Tesla owning Bitcoin as a hedge, right? If the US dollar is being debased at that rapid rate, you want to own something that has a chance of going up. One of the fun stories in our space is MicroStrategy. It's a software company that invested 1.5 billion into Bitcoin and now has institutional investors like Blackstone and Morgan Stanley owning more than 30% of its stock, and it's now worth $6.5 billion. That's going to bring in more institutions. It just makes the markets go up more. So mainstream adoption, we're seeing it a lot easier to get access. We did one of these monthly calls a few months ago comparing the rally in 2017 to the rally that we're experiencing now. And one of the massive differences is in 2017, it was exceedingly hard to get exposure to the space. Your exchanges were very clunky and you had to take a selfie with your passport and wait for a week to be able to buy cryptocurrencies. Now, PayPal's offering 340 million people instant access to crypto. So I think firms like Morgan Stanley, Bank of New York Mellon, all those firms are really just going to help more and more people get access to the space. So I think that's really the story for the next 18 months is the ease of access is going to bring in new investors on the retail side. And then on the institutional side, as again, I've been pitching the benefits of crypto for 8 years. The huge one was always, what about custody? And, that was where you had to be just pretty direct with people that there really weren't any regulated custodians back in the day. And so risk and reward had to go together. Now all of those kind of due diligence fiduciary questions have been ticked off. So you have very institutional exchanges now. The CME Group's been running futures for 4 years. And you have big firms that grew up in this space like Gemini and Coinbase. And then the Intercontinental Exchange, which is the parent company of the New York Stock Exchange, uses all their same infrastructure for Bakkt. So the exchange space is now very well taken care of. The custody one was a huge issue. You now have firms that grew up in the space like BitGo and Coinbase doing it, but also you have firms, like Bank of New York, Mellon, Fidelity, that are, entities that have been known and trusted for a very long time. And then one of the most important things for people that want to do more than just trade one currency, Bitcoin, is to have a prime brokerage type solution. And we're invested in a few like Amber and Tagomi, which was acquired by Coinbase. So it's a lot easier to get invested in the space. And the last issue that institutions have is regulatory clarity. I would say that we're almost done with that. So many of the regulatory bodies in the United States were very early in ruling on Bitcoin and ruling always in the most favorable way. For example, the IRS ruled in 2013 that Bitcoin was property. So you get long-term capital gains tax treatment if you owned it for more than a year, which is fantastic, way better than the tax treatment on gold, which is taxed as a collectible. And then paper money is always ordinary income. If you bought the euro 20 years ago and sold it at a profit, it's still ordinary income. The only thing, and then the CFTC has always been very progressive. One of their commissioners came out to my house in 2013 to meet with a group of people in the crypto space to figure out how to be very supportive of the space, and they've supported Bitcoin and now ETH futures for many years. The only thing left is the SEC. They are coming to conclusions on cryptocurrencies. There's a few, Bitcoin and Ethereum, that are not securities, and then there's a few that are securities. And then the rest of the space is treated essentially de facto as if they are securities. And I forgot to mention, the OCC ruled last year that any nationally chartered bank can custody crypto. So now the fun bit, let's talk about why it's an important asset class. I've traded macro for 35 years, looking for trades where the upside's much bigger than the downside. And there's been some interesting trades along the way, Russian privatization or Argentine farmland or whatever, but the scale of this opportunity is just off the charts. Cryptocurrency is disrupting the biggest markets on earth, literally. So it's going after digital payments, which is a huge, massive, and very expensive space. It still, costs about the same as it did in the 50s to do a credit card transaction, which is obviously not highly competitive. Gold's been great for 5,000 years, but Bitcoin and other blockchains have some big advantages over gold. And then money, which most of us don't think about on a day-to-day basis, that's $100 trillion market. So cryptocurrencies have a long way to go, and that's why I've been advocating it. It's certainly a very speculative new product. It's only been around for 12 years, so it's definitely going to have higher volatility and be more speculative than most of the things in an institution's portfolio. But there's nothing else in somebody's portfolio that could actually go up 10, 20, 30x, which Bitcoin can't. So here's a graph of Bitcoin over the many years, graphed exponentially to take out the crazy disruptive growth curve of it. It's actually really, really consistent. Bitcoin goes up at a compound annual growth rate of 213%. It's been doing that for 10 years. And so when people ask, what is my forecast for where Bitcoin will be a year from now? I've been saying, and I will continue to say, it's going to be 213% higher, because that's basically what happens every year. One of the huge other advantages and reasons why it should be in one's portfolio is it's uncorrelated to everything else in the world. And there's nothing like that. When I started out, I was a bond trader, and I came to work, all I thought about was bonds. I didn't know anything about what's going on in equities. I didn't care about commodities, I didn't care about anything else. But since modern portfolio theory has been so successful, essentially everyone owns the same portfolio. And so when there's a shock like the virus, everything goes down together because everybody's trying to sell exactly the same stuff. Bitcoin is not very well owned. Most institutions don't have a real meaningful direct exposure to cryptocurrencies. So it has essentially zero correlation to the rest of the asset classes. That is the dream asset, something that goes up 213% a year and has zero correlation. Certainly deserve to have a couple of percent in anyone's portfolio. So when thinking about valuing Bitcoin, and how one gets their head around it, a lot of it is just supply and demand. The more people that use it, the more the price goes up. And we just published in our investor letter a table that I love. It's one of my favorite graphics we've ever done. The price of Bitcoin has been incredibly consistently connected to the number of people using Bitcoin. And it's been doing this again for 10 years. So for 10 years, the number of people using Bitcoin has gone up by one order of magnitude every 2 years. And the price of Bitcoin has gone up by exactly one order of magnitude every 2 years. There's only one exception. In February 2016, the price was slow to catch up. But to my mind, this is just an amazing, amazing change to have two pieces of data go up 5 orders of magnitude over 10 years and have that hold. So thinking about where that could go, there are 3.5 billion people on Earth with a smartphone, and a smartphone is the only requirement to participate in the blockchain ecosystem. So if you extrapolate this out, price would hit 700,000 at some point. A lot of people have competed to make the craziest forecast for the future price of Bitcoin, most not based on anything whatsoever. This one actually seems pretty real and pretty doable. So I think at some point, you will ultimately see the price of Bitcoin hit something like this. Okay, so getting back to how does one value it? It's Joey's talking about Eurodollars and cash flows, and there are some people that are frustrated that cryptocurrencies are hard to value. It really, and I know this is unsatisfactory to some of you, it really is supply and demand. There's 21 million Bitcoins, and the more people that think Bitcoins are useful for whatever, there's hundreds of different use cases, the more the price goes up. And in the last year, we've had two massive shocks to our Econ 101 style supply and demand graph. The demand for Bitcoin has had some huge quantum leaps up. When PayPal went live, you could literally see it on the screen, the number of people trading through ItBit, their exchange, and that obviously was driving the price up. Coinbase buying, or I'm sorry, PayPal buying more than 100% of all the newly issued Bitcoins. And now you have new firms like Morgan Stanley going live who undoubtedly are buying more than are being issued as well. So when you have more new entrants buying more than 100% of what is being supplied, the price has to equilibrate higher. The other huge thing that's happened is what's called the halving. So Bitcoin's money supply formula is very predictable. Every 10 minutes, the number of Bitcoin are issued. It's 6.25 Bitcoin right now. And that money supply formula is fixed. And every 4 years, that number is cut in half, and it just keeps getting cut in half for the next 100 years until it stops when there's 21 million Bitcoins out there. So there's no Greenspan put to bail out politically connected groups like homeowners or stockholders. If there's the markets are going up, the markets are going down, no matter what, it's just 6.25 Bitcoins every 10 minutes. When the number of Bitcoins is cut, it has had a dramatic impact on the price. This graph has shadings of the year and a bit before a halving, and then a darker gold shading of the year and a quarter after the halving. And across those cycles, there's been a very predictable pattern of the amount of price increases based on the percentage change in the number of Bitcoin issued. The first halving had a really big impact because there weren't very many Bitcoins outstanding, and the supply was being cut in half. So it reduced the next year's supply of Bitcoin by 15% of the stock of Bitcoin that had been in the markets prior to the halving. The second halving obviously was half as big, a number of Bitcoin, and then there were a third more Bitcoins outstanding. So it reduced the supply by about 5% relative to the outstanding stock at that time. So it had about 1/3 the impact in price. This halving is again half as big, and there's more Bitcoins outstanding. So it's about 1/3 as big of an impact as the 2016 halving. We used all of those ratios to predict a path of Bitcoin in response to the 2020 halving. And in our April investor letter last year, we predicted that Bitcoin would hit $62,968 last week. And it did. And that's just pretty wild. So when people start articles about how crazy the rally is in Bitcoin, I really try and take exception. It's not crazy. It's predictable. It's totally predictable. We think the price of Bitcoin is going to hit 115,000 this summer. It's been on that pace, in the past for a very long period of time, and so it seems highly likely to be able to do that again. One of the big knocks on Bitcoin, or one of the fun ones that people like to say, is it's too volatile. So institutions, don't want to buy it, or people don't want to bring it to their investment committee because it's too volatile. Bitcoin's had incredible volatility. Right now, it has about 70% annualized volatility. So it's just a little bit more volatile than Amazon stock, which is about the same size and kind of as disruptive as Bitcoin. So I don't think it's surprising that it's that volatile. Here's the cool factoid, though. Even with 5 bear markets that have averaged 83% over the years, Bitcoin has only printed 1 down year. It's had every year that even if it's gone down on average 83% in these bear markets, it stops higher than it was before. And to my mind, that's the best reason that someone should want to have this in their portfolio. That although it is definitely high octane stuff and it goes up and down a lot, it goes up more than it goes down. All right, so that's the reason one might want to have it. And we have 4 different funds that help investors get exposure to this space. We have everything from super liquid daily liquidity funds all the way out to 10-year venture funds. So on the next slide, we have a highlight of our funds. We're currently managing $4.5 billion of assets for our investors. We have 4 main strategies, and we have invested across 8 different funds. We have 3 venture funds, 3 different versions of our early stage token fund, our Bitcoin fund, and our liquid token fund. The average IRR of those funds is 93%, which again is just ludicrous. And so it's just one of the best and easiest ways to describe why this space is worth having a bit of one's portfolio. So wanted to go over our hedge funds. We started all these different hedge funds over the years. As I said, we were the first in many of these things, and they kind of had names that made sense at the time, but they didn't make sense in their totality here. So we've changed the names of our funds to be much more self-evident. We have an early stage token fund that invests in tokens when they are prior to going public, when they're just kind of like early stage venture. That fund typically holds projects for, on average, maybe a year and a half. Sometimes we hold them for 3 or 4 years. Sometimes, they achieve our price targets very quickly and we're able to sell them. We then have a fund that invests in liquid tokens. So it's trading, Bitcoin, Ethereum, all the liquid tokens that one would want to have exposure to. Both of those funds are quarterly liquidity. So we're passing through the liquidity that the underlying assets have. And each of those funds takes in subscriptions every month. So to the extent someone's interested in investing at any month end, you can get into those funds. And then Pantera Bitcoin Fund is the best performing Bitcoin fund in the United States. It's up 78,000%. That fund as well passes through the low fees and low and high liquidity of the underlying. So it's daily liquidity. Investors can come in or out any US banking day, and it just charges 75 basis points management fee, 0 performance fee, and a 1% redemption fee when someone comes out of the fund. We want to announce that we are offering an offshore version of our liquid token fund. That's been a frustration to non-American investors for the last 4 years, where we weren't able to offer it. We're now able to do that starting on May 1st. So for investors that want liquid exposure, but are offshore of the United States, that's opening up May 1st. That fund is mainly discretionary, but 10 to 20% of it is driven by a series of quantitative models that we've been building for 4 or 5 years. And the important point to stress is the value of active management. So far this year, Bitcoin is up 116%, which obviously in the normal world would be insane performance. But our liquid token fund is up 350%, and that is from the very active trading of cheap protocol tokens versus other ones. So I wanted to highlight our venture funds. Unfortunately, none of them are currently open. We've closed our 3rd venture fund, and we're in the process of investing it. We will soon be launching our newest fund, Pantera Blockchain Fund, and it is an effort to combine all of our strategies into one wrapper. So in kind of as a historical happenstance, since we invented cryptocurrency funds and then early stage token funds and things like that, we ended up with 4 different funds that each asset could only go into one of our funds. And then there's been a demand from particularly endowments and other institutions to have a product that goes across the entire spectrum. So Pantera Blockchain Fund is that product. It will be investing the same things we're investing in our existing fund structures, but just doing it via one single fund. And the terms of that fund are, it's set up like a 10-year venture fund. We'll have a 25% drawdown at the beginning of the fund, and then be doing quarterly drawdowns of equal size for the next 2.5 years. So it's a way for people who want to get exposure to blockchain, but don't want to micromanage, whether it's going to be early stage tokens versus liquid tokens. And the next slide has some of the details of the fund itself. That is a fund that we are going to have a very quick first closing. We're going to close on June 30th with investors that are able to close, do their work and close quickly. We're doing that because there are so many interesting early stage token deals and venture deals that we're seeing. And our 3rd venture fund is close to its reserve. We're reserving 30% of the fund for follow-on. So it's the time to raise a new fund to take all the new venture deals that we see. That fund will have subsequent closings for several quarters after that. But we are excited to get the first closing in at the end of June. With that, that wraps up our prepared remarks. I know we've been answering questions in the Q&A box. Happy to, if anyone wants to raise their hand to ask the live question, happy to do that. I'll take a look at some of the questions that could be generally interesting. We'll answer them live. And Joe, you might want to talk about AMP and Flexa because it's an interesting position.
Yeah, so for AMP, what Flexa is doing, so they used to be known as Flexa. What they're doing is building basically a payments protocol for cryptocurrency to pay with crypto at merchants. Prior to COVID, they were making it so you could pay with merchants in stores. So you could just use your phone and pay with crypto, whether that's Bitcoin, Ether, or like USDC, stablecoin kind of thing. They're currently, they've been working on it for a while, making it so that you can pay merchants online as well. But I don't think that's launched yet. I think that's kind of the next big thing for the business. There's also some other stuff they're working on that's not public yet. And so I think it should be interesting over the next couple quarters as they get those products shipped. But that's sort of where it's at right now. There's a question about where are we at in the cycle, which is a common question people ask. And then, what do you do in a bear market to generate excess returns? So I think where we're at in the cycle right now is probably, I think somewhere around the end of the year. It'll likely be the end of this current cycle. Most of the upward movement in the cycles happens in that second half. So it doesn't mean that the majority of price movement is over. If you look at like the stock flow model that Dan mentioned, usually the price overshoots that by some amount. And so you could see Bitcoin go over that number. And then the second part of the question references, altcoins. We expect that those will outperform Bitcoin over this part of the cycle. Over the short term, there might be, Bitcoin may be a bit oversold and it may bounce back a bit on a relative basis. But I think over a 6-month horizon, we're pretty confident that things like Ether, DeFi assets, and other stuff will outperform. And then as far as bear market, throughout the bull cycle, we've been pretty regularly de-risking the fund when we think that things get overheated and then redeploying at lower prices. During the bear side of the cycle, the way you would have to generate excess returns would be to attempt to do the same thing there. And then, the crypto cash markets are a lot more interesting this cycle than they were last time. There wasn't a whole lot you could deploy your cash into last time. Now there's lots of DeFi lending protocols and things like that allow you to get a yield on cash that's much higher than traditional markets. But most of the excess return will come from selling early as opposed to getting a yield on cash.
I'll just add something to Joey's thoughts on the markets as a whole. Obviously they're up a lot relative to kind of any normal market. But as we showed in that log graph early on in my presentation, they're just back to their 10-year log trend growth line. So I actually just don't think crypto's overheated right now. And then with all these new on-ramps, like Morgan Stanley coming on, I think you have another, at least 9 months, maybe, 15, 18 months of really high likelihood of going up. I mean, I just think the market is more than a 50-50 chance of going up. If we get to our forecast of 115,000, then you're starting to get in the higher end of the spectrum. But the markets have typically peaked when they were multiples of where they should be on trend growth. So I do think we're in the very early stage of a big rally here. There was another question I'll just answer live because it's an important one, is what the overlap is between our early stage token fund and venture. So historically, any asset we did could only go in one of our funds. If it's equity, it had to go in our venture fund. If it was an early stage token, it had to go in our early stage token fund. The distinction would be any early stage token that was illiquid, so it had more than 2-year lockup, would go in venture. And so we use liquidity as our criterion for splitting between funds. And that worked well for 4 years. And the world used to be a lot clearer, in the earliest days, everything was either a token or equity, Bitcoin, Ethereum, have protocol tokens, but they certainly don't have any equity. And then almost all the venture-backed companies we backed had nothing going in the token space. Needless to say, the world's gotten a lot more complex, and there's a lot of projects that have both or could have both. Also, the SEC weighting in on the token space has kind of forced some things to be structured as equity, even though, you know, probably ultimately it's going to end up looking like a token. So that is one of the reasons we decided to do our next early stage type vehicle, or vehicle that invests in venture and early stage tokens, to be a single fund. And so going forward, when we make investments, if it's equity, it will only go in the blockchain fund. If it's an early stage token, it'll be split pari passu between the early stage token fund and the new blockchain fund. And Joe, I'll let you answer a few questions if you want.
Sure. Let's see. There's some questions about like how we think about de-risking positions or managing risk in the early stage token fund. You know, I think on that, I think there's two aspects to it. One is like, you know, how is the position doing as the thesis that we invested in it played out, or is there a reason that's not playing out? And, you know, if we think the thesis is no longer playing out, we would look to get out of the position. The other scenario would be if we think the thesis has been way overplayed. So an example would be like if you invested in something that was like an ETH competitor and you thought it could get to, you know, a certain, you know, ETH that asset ratio, and then it got to that ratio and then it like went, you know, way above what you thought fair market was, that would be a good signal to de-risk from that position some. The other aspect would be based on, you know, percent of the portfolio. The balance there is that with the early stage token fund, you know, it's investing in things that are basically early stage venture. And so, you know, if you invested in a great company, if you invested in Facebook at the seed, you know, it would be silly to de-risk it at the Series C. You want to try to hold as much of it till IPO as possible. Here, the difference is that everything is liquid from pretty close to day one. And so you want to make sure that you don't sell a winner, you know, too early. I think the other aspect towards de-risking is that, you know, when we think the market is overheated, based on our models, you know, we look to de-risk the portfolio overall, taking a big portion into cash that we can then redeploy over the bear market. I think those are the two angles to the EST risk management.
There's a question on fees of the new blockchain fund. It will be 2 and 20 venture style fees. And the exposure split between the strategies in the new blockchain fund, it'll probably be 40 or 50% venture, 20 or so percent early stage tokens, and the balance in liquid tokens. That's probably a lifetime average. I would imagine that in the early days, it will have more liquid tokens. And then as we find new venture deals and new early stage tokens that are illiquid to invest in, we'll convert from the liquid tokens into the early stage stuff. And the question about the estimates on price, the only thing we've used to make estimates are either the 10-year log trend, and that is, you know, obviously just a regression, and then the halving stock to flow is a ratio of the, it's a ratio of two ratios. It's a ratio of the reduction in supply over the, I think it's 434 days or something after a halving to the outstanding amount of Bitcoin at the day of the halving, a ratio of those two relative to the price changes over those periods, and then applying that ratio to this new 2020 halving. So we don't do any kind of Monte Carlo simulations. Those two are just based on historical data.
There's a question about custody. You know, we mainly use Coinbase and BitGo as custodians. I think custody is something it's important to not roll your own or get too fancy. Those players have both been around in the space for a very long time, and they've both, you know, been proven to be secure. And so we like to just keep it fairly simple and go with, you know, what works. There's another question about markets outside of DeFi. Somebody said, you know, somebody recently said that the TAM for blockchain is everything. When do you see traditional markets like insurance, legal, accounting being disrupted? I mean, I do think that DeFi is kind of the logical area to be disrupted. Um, it's the area where I think we'll see the most growth. Things like insurance will be disrupted by DeFi for sure. We're already seeing the first use cases of this where people are building insurance protocols to insure other DeFi projects. And if you think about like on the scale of 1 to 10, what's something that's really hard to insure? Ensuring like a smart contract platform that's only been live for a few months or a couple of years is way more difficult than ensuring most of the things that legacy insurers do. And so once they kind of prove out those beachhead markets, it wouldn't surprise me at all if these smart contract insurers then say next, hey, why don't you insure your balance on BlockFi or your balance in Coinbase, and you'll have insurance markets that enable you to buy insurance on that. And then you could envision them expanding, to other areas. So I think that will be an area that for sure gets disrupted. Like accounting and legal, I think those will always be professions that are going to be around, forever. I don't think you're not going to have like a blockchain that replaces your lawyer. It might make accounting easier though, in some cases, once the software improves.
Joey, I'll take one. Speaking of replacing, there's a question on how would you quantify the risk of Bitcoin being replaced? So by ETH or something else. So I think the right mentality is this isn't a winner take all situation. There's dozens of use cases. There could easily be dozens of interesting blockchains. So it's kind of like, Bitcoin maximalism is kind of like in the 90s being a Yahoo maximalist. Yahoo was a good company, but there were 30 other important companies in the internet space. And that's the way you should think of blockchains. We do actually have a very strong view, though, that while Bitcoin's going to rally a lot, we think that Ethereum's going to rally more than Bitcoin. And that Polkadot which is kind of a newer version of Ethereum, will rally even more than that. And then DeFi protocols and other tokens built on top of Polkadot and Ethereum will rally even more than Polkadot will. And we just published that in our investor letter a couple of days ago. We're actually going to tweet about it today and get all the Bitcoin maximalists fired up and pissed off at us. So, our logic is in our letters, but one really cool, very easy metric to follow that is we have a graph that we published when we first made that view 3 or 4 months ago, which is the market share of everything other than Bitcoin and ETH. And in January, I think it got down to 16%. So all 5,000 other tokens were only worth 16% of the entire market. And that's now 36%. So, while Bitcoin's gone up a ton, the everything else sector has gone up more. So we're really bullish on stuff built on top of Ethereum and Polkadot and that, and our liquid token fund is 70% in that, which is obviously massively not market cap weighted. We have very low exposure to Bitcoin. There's a question on offshore investors and minimums and things like that. We really tried to keep all of our funds accessible. So the statutory lowest limit on many funds is $100,000. So we've made it $100,000 across as many funds as we can. Unfortunately, for the blockchain fund, it has to be $1 million. So that's the only fund that is a much higher minimum. You could actually replicate the blockchain fund pretty well by doing positions in our smaller funds. You missed the venture bit, but you can get all the rest of the exposure. And there was a question about onshore and offshore US citizen. I think if you're a US citizen, you have to go in the onshore version. If you are a non-taxable entity like an endowment, you can go in the offshore. But obviously, check on all those things with your own advisors. Question on, are we investing in public companies like Coinbase and miners? We do have a position in Coinbase from having owned it before. We're not actively seeking to start trading public equities. In the next few years, there'll be more than a handful. So we'll probably expand into that in time. But right now, it's not something we're actively looking to do. And the thing on miners is, we certainly have an edge in some things, but like chip design and fabrication extremely low power generation is not something that our team has any particular edge in. So that's the one area of blockchain that we've never invested in. And there was also a question on the Chinese central bank currency. It's a massively important thing, both geopolitically and also for the blockchain industry. So I guess the way to say it is, the blockchain concept is out there now. You can't get the toothpaste back in the tube. So China and other countries will build their own blockchains. At our previous investor summit, the chairman of the CFTC, Chris Giancarlo, did a speech on that being America's Sputnik moment when China announced their payment rail. I really do think it has massive implications. The United States exerts tremendous power around the world with its sanctions regime. And if there is a payment system like a yuan blockchain that is outside that regime, it changes the balance of power in the world. That has forced now the US Fed to get engaged and has a project with MIT to build out a US version of that. All of that is, I think, net positive for our industry. Obviously, some people will think the Chinese cryptocurrency is good for them, and some people think the US dollar crypto stable coin is going to be good for their use case. But ultimately, those are going to depreciate at the same rate that the paper dollar is depreciating or the paper renminbi. And so I think a lot of people will realize that buying a fixed quantity blockchain like Bitcoin is way better. So it's going to make the pie massive, and the Chinese version is going to get some slice of that pie. The US Fed coin is going to get some slice of that pie, but I think it'll make the Bitcoin slice bigger too. So we're generally, very bullish.
There's a good question here about, somebody says, does the halving apply to Ethereum? And if so, would that impact the price? So Ethereum itself doesn't really have halvings like Bitcoin does, but it has another event that's going to be much more impactful than a halving would be. And that's when Ethereum, when the network switches fully to proof of stake, and when this thing called EIP 1559 gets enacted. And what that does is it makes it so that when each Ethereum transaction goes through, some percentage of Ether to pay for the transaction gets burned. And so that, combined with proof of stake, which results in a huge decrease in the number of Ether emitted per block, if you add those things together, it actually results in should be deflationary schedule for Ethereum, meaning in each block, there's actually negative ETH being printed. The supply is going down over time. And so that's something that the market does not really understand or grasp yet. There's obviously portions of the Ethereum community who understand it, but I don't think the average participant in the market knows that or realizes it or really has wrapped their head around that yet. But it's a really powerful dynamic because it means ETH is going to be a deflationary asset, actually more deflationary than Bitcoin itself. And so I think that's a very, very positive thing for the price. Because it's sort of like, I saw somebody refer to this, I think on Twitter, they called it like the cliffening. It's not like a halving, it's like literally like a cliff, like there's just not going to be any more Ether printed and it's going to go down over time. And so that's goes into part of the reason why we're so bullish on ETH and why we think it's a great risk reward, trade versus say BTC. And that should happen sometime late this year if it goes according to schedule. There's another question about how do we source deals and how do we source investments and deals, that kind of thing. I think there's a few ways. One is almost all of it is inbound. So it's either other entrepreneurs we've invested in, have a friend or know somebody who's starting the company you think it's interesting, so they tell us about it, and that's how we see the deal. The other is other investors, people who are maybe smaller investors, or they're other investors from more traditional firms, and they want a deal that they're looking at, and they want our feedback, or they're an angel who invested in a deal, and they want to try to find a good lead for the deal, so they'll introduce them to us. Those are probably the two kind of main ways that we find deals. There's a few times we'll find something where we'll come across something and we'll reach out to the company and find it that way outbound. But I'd say the bulk of our deals are inbound deal flow. The business is really reputation based. If you help founders out and are honest, very straightforward, and don't really cause people problems, that's like the best thing you can do as an investor. Basically, help people and don't hinder their business, and then deals will start flowing to you. It's a pretty simple business, but people tend to not always do that. And so we've been around a long time. We've been through multiple market cycles, and so we're pretty long-term investors. Versus crypto, what you see is each time the market goes up a lot, you get a huge influx of what I would call tourists who kind of come into this space. And so as an entrepreneur, if you're trying to decide, between somebody who's been in this space for years or somebody who just got in 6 months ago because they think it's hot, it's a pretty clear, choice on a relative basis. That's like gets into like sort of why we win deals, is that and the help that we provide entrepreneurs.
Joey, I'll answer a couple. Somebody asked about the best research sources to get up to speed on the space. We try and list a bunch of further reading from very short little blogs all the way through full books in our investor letter and on our website. And there are some great sources there. We'll take another crack at making sure we've updated it, but that's the best source. And then somebody asked about downside protection in this bull market. Yeah, we're very conscious of that. The early stage token fund can only be long, but the liquid token fund can actually short tokens. It's not a huge part of our policy now, but when Bitcoin does get to those hundreds of thousands of dollars ultimate terminal value, it will be full on long short fund. What we do is take the net exposure down when we see the markets get overheated. And Joey mentioned earlier that in February, we thought the markets were quite a bit ahead of themselves, and we took 20% of our risk off, and the price did come down 27%, and we captured about 80% of that move and put it back on. So we are trying to be conscious of that. But I want to stress, we think Bitcoin is going to 115,000 over the next year. And so we don't want to be too cute in trying to, over trade it. We want to be in it. Anything that has, the ability to go up, 3.2x per year, you don't want to be flat or short, for long periods of time. So I think oh, go ahead, Joey.
I was just gonna say, I just saw 2 or 3 questions pop up about proof of stake, probably because we just mentioned it. People were asking, what's the benefit of proof of stake? What does it do or enable? And basically what proof of stake does is it opens the door to more easily scaling Ethereum, like Ethereum itself. There's a lot of talk about scaling Ethereum via what are called layer 2s or platforms kind of built on top of it. To actually scale Ethereum core, the main underlying blockchain, the way you would do that is there's this thing called sharding. That's going to derail the conversation and be really complex. But the punchline is that proof of stake opens that up and makes that much easier to do. It's really hard to build systems like that using proof of work. The other benefit of proof of stake is it's much more efficient. And so you actually don't have to print as many coins for the system to run. That's part of why ETH issuance is going to go down so much. And then the last piece is that there are benefits, from like an environmental standpoint. You're not, burning as much electricity to run a proof of stake network because it doesn't require all this complex hardware like mining does. It's just running, in a server, but it's not, doing these complex hash calculations that you would see with Bitcoin. That's sort of like a nice side benefit.
There's a couple questions on the new blockchain fund and kind of the mechanics of how it'll work. So starting in July, any new venture deal will go into the new blockchain fund. The existing venture fund 3 will save the 30% that it has left for follow-ons in existing portfolio companies. So all new venture deals will go into the blockchain fund. And then when we do an early stage token, every deal will be split by the ratio of the AUMs of the 2 funds. So if they're equally sized, half will go into one fund, half into another. So the blockchain fund will essentially get all the new venture deals and then whatever percentage of the early stage deals that it represents on an AUM terms. Yeah, I think there was another question about the blockchain fund that I forgot to answer. But so I'll let it, Joey, if you have any more you want to answer.
Yeah, there's one more I think about what size are the positions in the liquid token fund? Meaning, are they mostly large caps, or the mid caps, or they're small caps? That sort of thing, and how often do the positions change? And so I'd say in terms of positions changing, we own about 15 to 20 positions in the fund. Any given quarter, there's probably one or two things that come in and out of the fund because like the thesis behind the position just changed, or there's a new position that we like a lot. I'd say the more common trades throughout each month are changing the weights of things. We think things are either under or overvalued. And then some of the more macro trades that Dan talked about, de-risking and then putting risk back on. As far as size of the positions in the fund, I'd say it's pretty barbell. 30 to 40% of the fund is kind of what I would consider large caps. Maybe 10 to 15 is what I would consider mid caps, and then the remaining 50% or so is what I consider more small caps. That's just where we think the best risk reward is in the large caps and the small caps, not as much in the mid caps.
Yeah, I think that's actually the easiest way to describe what the fund is doing relative to the markets. 52% of it is in cap token number 13 and down on the CoinMarketCap type ratings. And that they represent only 9% of the actual market cap of the industry. So we're making a very, very, overweight bet on the smaller tokens out there. And then on the flip side, Bitcoin and Ethereum are used to be 80%, now they're 75% of the entire market, and we only have about 30% of our fund in those. So we're making a very big bet that the small DeFi style tokens are going to outperform the two biggest tokens. And now that we're down to questions about the Canadian regulatory framework, I think we are out of information that we can share with you all. I don't know anything about the Canadian regulatory framework. So thank you all for participating. If you do have other questions, our investor relations group at IR@Pantera Capital can route those questions to the appropriate person internally. Thank you all.